Congratulations! You found the Pirls Stock Market Commentary for market week ending Friday, January 9th, 2015. Market breadth. With this past week's market decline, our bull-bear point and figure ratio fell from 1.05 to 0.83, dropping back into bearish territory. The total count of securities in bullish or bearish patterns fell 3% to 2,428. The count of bearish stocks increased 9%, while the count of stocks in bullish patterns decreased 14%. The Pirls P&F Market Breadth Summary Chart shows us a market now 1 week in bearish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking on Membership, and clicking Sign Up. For those who are interested, a free 2-week trial subscription is available. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 101 points for the fifth fall in 12 weeks. At a positive 67.02 points, it continues below all 9 tops above plus 100 and above all 6 bottoms below minus 100 in the last 3 years. Market gauge volume analysis. In this week's volume analysis, all indexes ended in neither accumulation nor distribution mode. In the last 2 weeks, the Nasdaq 100 Trust had 0 accumulation days and 0 distribution days. Of the other indexes, both the Diamonds Trust and the S&P 500 Deposit Receipts ended in neither accumulation nor distribution mode. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Nasdaq 100 Trust ended in neither accumulation nor distribution mode. In a Woody's uptrend begun 2 weeks ago, the CCI 20 daily fell below 0 for 3 consecutive days. Now, at minus 4.01, has 1 day below 0 and is within the plus or minus 50 range for a valid 0-line reject entry signal. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 27 weeks ago, while the daily CCI 20 began a Woody's uptrend 2 weeks ago. At plus 41.97, the CCI 20 weekly in a Woody's uptrend is now within the plus or minus 50 range for a valid 0-line reject long entry signal should the CCI 20 weekly move up this coming week. Industry rotation the last 2 weeks. 3 of the top 5 industries are positive, and all of the bottom 5 are negative. Bullish, S&P Retail, and REITs continue in the top 5. Oil Services has entered the bottom 5. Oil has left the top 5 and entered the bottom 5. Computer hardware and comp tech have left the bottom 5. Bearish, banks and brokers have entered the bottom 5. Gold and silver continues in and now leads the top 5. Focus this week with the possibility that the international dollar is now backed by gold, as is being considered by various informed sources. It's worth looking at an Elliot Wave analysis of the technical waveforms of the dollar index, DXY. From Elliot Wave Technology, cash flow is king. We advise considering the chart patterns and the following points concerning precious metals, hedging, and the dollar. Real or contrived via manipulation, the dollar price per ounce is the only reason anyone is interested in acquiring monetary metals for hedging against inflation or monetary collapse of one sort or another. The primary reason for investing in and maintaining possession of physical gold and silver is to insure, hedge, and protect oneself from the ravages of inflation or from a severe monetary crisis occurring within the global fiat empire. Think about it this way. You're in a corrupt system that may or may not implode in your lifetime, and you seek to hedge and protect yourself against this. So you invest a measured portion of your worth in physical gold and silver bullion. That's great, but you can't stop there. Just as you are so inclined to hedge against the plausible disaster, you must also set aside ample resources and the means to hedge your hedge. Meaning that if the dollar doesn't collapse and instead the paper prices of gold and silver collapse further, and you still maintain conviction in wanting to hold this insurance without going broke, you have to protect and defend the value of your chosen insurance vehicle. At the end of the day, all we're saying is, please don't delude yourself and overinsure to the point of looking foolish at best or going broke at worst. A common ratio of gold and silver investments relative to net worth is 10%. Meaning that if you have a net worth of $1 million in current dollars, it would be prudent insurance to hold $100,000 worth of gold and silver. When the long-term trend turned down upon calculating the worth of your holdings in present dollars, you could then have used appropriately sized futures contracts or inverse ETFs to protect a proportionate and specific value of your holdings against further dollar-based declines. As such, with that hedge protecting the value of your insurance policy in place, at some point in the future, when the long-term trend reverts to the upside, you could then lift your short positions in the paper markets. It's that simple. Thank you for tuning in for this week's Sand to Pirls Stock Market Commentary, compiled by Donald Pirl, www.s2pmarketsignal.com. Hoping that you have experienced a peaceful and pleasant weekend, that you're ready for a great week coming up, and wishing you true success.